a question that naturally arises when you're investing in the market is, well, how much can you really make in the stock market? The truth is that when it comes to the stock market, there are so many strategies that you can employ to try to grow your starting balance, but one that is tried and true for many passive investors and beginners is the index fund approach. I alluded to this a little bit earlier, but that's where you consistently invest into an index fund that tracks, say, the S&P 500. If you were to do that, your annualized returns are going to be anywhere from 8 to 10% on average. That means every month you have an extra $1,000 to invest into the stock market. But there are two factors at play here. One key to investing, then, in my opinion, is continually investing and trusting the process. On average, though, you should come to expect the 8% number that so many people like to talk about online. I want to show you guys a fascinating example, though, of how time in the market can really just trump trying to time the market altogether. So that basically tells us that to accumulate our wealth in an aggressive manner, we should just keep buying no matter what. He uses an excellent example that if you were to search on Google, stock market overvalued 2012, many articles will come up detailing what investors believed at that time. They believed that the market was overpriced by 50% in some cases. But look at this graph from the S&P 500. In 2012, it was trading at 1,400, and today it's trading at close to 6,000, if not already over that. If you had believed it was overpriced back then you would have missed out on some serious gains, as 10 to 15 years later, we're pretty close to nearly 3 times that. All right, so now that we've covered that, let's actually go over what is the stock market and what is a stock. So basically, the stock market is just a marketplace that is now all digital. And in this marketplace, people are buying and selling stocks left and right. When you buy a stock, you're purchasing a small piece of ownership in a company, and you're typically buying it from someone that is selling it to you on the open market. Owning a company's stock gives you claim on its assets and earnings, and the stock market allows you as an individual to trade these shares, and the prices of these shares will fluctuate based on factors like supply and demand, how well the company is doing and its expectations in the future, or share prices just might fluctuate based on broader economic conditions. The stock market then is just a system that allows people to connect to one another in order to trade these shares. Now, to quickly explain why companies would even want to sell their shares on the open market, the reason is that companies sell their shares on the open market primarily to raise money for growth and expansion. They like to raise capital, and this process is called an IPO, or initial public offering. You might have heard that term before, but basically it means that the company has gone public and sells their shares on the open market, giving a larger pool of investors access to that company's shares, including you and me, and therefore we can speculate on the price and perhaps the future direction of the company.